Hey traders, David Frost, MyStrategicForecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, October 7, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Actually, there's a lot of stuff on the docket, so let's go over it one by one. We're going to start to get into earnings season. It starts late this week. The financial companies, some of the big banks will start to report. And then over the next, let's say, week to 10 days, they really start coming fast and furious. And that'll last a good 4 to 6 weeks. So we should get an earnings bonanza where companies will do the proverbial beat the lowered expectation. Hold that thought for a second. That'll come together in a few moments. Before we really dig into the current day's market, I want to give a bigger picture perspective for a second. We're getting into the fourth quarter. I want to give somewhat of a concept of a fourth quarter schematic. We're going to go with some hints about what I think is coming. COMIN apostrophe. Coming. Whether this happens before or after a new high, we're going to get some kind of a decline. I believe the decline will happen between now and either around the election or slightly after the election, but before, meaning conclude, but before Thanksgiving. So when you move the chart over and actually use the time, whether it started here or it starts next week or the week after, doesn't really matter. I think it goes into either late October, early November. I think they'll find the low before Thanksgiving, long before Thanksgiving. I'm not saying it even goes to Thanksgiving. And then you get that float them into Thanksgiving time frame. The holiday seasonality starts to discuss or be discussed all over the place. And then it becomes a self-fulfilling prophecy. But these are kind of the cycles that we should get around the fourth quarter. You're going to get some volatility around earnings. You'll get some lowered expectations. They'll beat the lowered expectations. They'll rally them. Just kind of the way it works. So what I'm saying is, don't be surprised at the pullback. Well, let's talk pullback. Now let's narrow it in a little bit and say, all right, where are we still? Well, we're still near the old highs. We're still near the highs. All they're doing is eating time off the clock. It doesn't matter that today was a down day. It makes no difference. They're just eating time off the clock in some kind of a flaggish formation. I could do this, and I could absolutely make the case that this is a bull flag above all the moving averages. They're building energy for another move higher. Who could dispute that after this market? However, we are the umpire. We are calling balls and strikes, and we are going to use 565.17 as the bogey. The bogey is still this low here. Even though it's been tested, I'm not saying buy it anymore. The trade from a luster's been taken off of it doesn't exist any longer. But this low here is 565.17, and that was essentially always our entrance point, the gateway to no man's land, all the way down to the gap, 561.40. So we're still using the same place as an Irene-ish number. If they get below, start closing intraday, and then daily below 565.17, they're going to be able to, meaning the bears, will be able to tack on another leg down. Write that down, put it on a sticky note. Now, whether they stop at the gap or go further, that remains a mystery. We don't have to decide that just yet. They're not even below 565.17. We have to see the velocity. We have to see when they do it. We have to see how they do it. We have to see the intraday activity. We have to see the volume. We need institutional participation and conviction. We need a whole bunch of things to make those kind of determinations. Might want to write some of that stuff down on a sticky note too. Speaking of lowered earnings expectations, let's talk Apple for a second. Everybody loves Apple. Everybody knows Apple. Everybody at least knows somebody that uses an Apple product. Apple was down today, about $5. Okay, fair enough. So I just happened to be preparing for the video. I never do this, hardly ever, but I did have the sound on CNBC, which I love to call Tout TV. Let's call it 3:30 in the afternoon Eastern Standard Time, something like that. Maybe it's 3:45, whatever it was. Now I'm listening in the background, and they're talking about the reason why Apple was down. I don't know if it was an analyst, whoever was talking at the time. I really wasn't paying attention. But what I did hear is Apple was down because it was downgraded by Jefferies from buy to hold. Okay, here's Yahoo. Everybody has access to Yahoo. Let's go over to analysis over here on the left. All right, ever do this? Watch this. This is kind of fun. Current year, 2024. Number of analysts, earnings estimates, revenue estimates, number of analysts. Okay, for the year, 39, 41. All right, we'll just round it and say 40 analysts in Apple. You got Goldman Sachs, you got JP Morgan, you got UBS, you got Morgan Stanley. You've got an endless supply of analysts. And today, the stock is down $5 because Jefferies went from buy to hold. What does that even mean? It means don't buy it. It means hold it. Even if it goes down, hold it anyway. Is that what that means? So you don't think it's going up, so I can't buy it. That's the analysis, but I should hold it. So if it goes down, I should continue to hold it? All right, I got it. But what if Goldman Sachs, JP Morgan, UBS, and Morgan Stanley all have buy ratings on it? Now, let's say, because this is true, Jefferies was going to downgrade Apple Monday morning, this morning. They went through a process to get the approval to come out and do it. They started this a week or two ago. This is all in the works. They didn't just come out this morning and say, yep, we're downgrading Apple, just like that. They have to go through a process. The analysts got to get approval from the director of whoever, from the VP of whatever, from the who knows what. Now, let's say the market was flat today and Apple was down 12 cents. Would anybody be talking about Jefferies' downgrade of Apple? Of course not. Microsoft down $6.50. Google down 4. Meta down 11. Tesla down 9. The list goes on and on. But Apple was down because of Jefferies. What about all that other stuff? See where I'm going with this? It's a bunch of hocus pocus, nonsensical stuff. Soapbox. Get back in our lane with the S&P. 565.17 is our current bogey. Below that, you can rest assured they're going to be headed toward the gap or lower. Stay above 565.17 and remember this drawing. You can come back and reference it anytime you want because it'll be memorialized here. This is essentially a bull flag until it's not. And we're going to say it becomes not a bull flag once they start getting below and closing below the red line at 565.17. How do you like them apples? This is a weekly chart of the S&P, SPY. Anybody notice anything? Have you taken the course, Lazy E-mini Trader? You notice anything about time? Time is more important than price. Do you notice anything? Inside the numbers, we're going to take a look at the commentary. I'm going to point out a few important numbers. Everything kind of happened in the afternoon when the market went down. This is a morning business. When the market goes down in the afternoon, hits and slices through numbers and does stuff like that, you have limited time left on the clock from a trading perspective, which is one of, not the only, not even close to the only reason. It's couple of different markets, morning to afternoon, but certainly is a big reason. Without time left on the clock, it makes trading more difficult. You have to make a decision on what you want to go home with. We'll start the day with the pivot at 568.85. Pivot never came into play today. They sliced through it in the afternoon, tried to fight back to it, but the day is coming to a close. This is a morning business. They did nothing with the pivot during the morning business. The bull case early on was staying above the pivot, which keeps the door open for 572.05. 572.05. Missed it by that much. Right in this candle here, the high was 571.96. Splitting hairs over pennies. Sometimes they come up short. Other times they spike them through. And what we've been discussing in the live room, because this is now happening several days in a row where they're coming up short, it's indicative of something else brewing, under the covers. There's some kind of larger move coming. Write that down, put it on a sticky note. Markets are likely about to get more volatile. Been saying that for a couple, 3 days now. Overhead resistance, 572.05, came up just about short. And then, if they get down to fill the gap, they can head down toward 567.05. And there you have it, 567.05 happened to be the late day / afternoon target / support bounce area. Problem is, from a trading perspective, you don't have a lot of time left on the clock. The other thing is, look what they did when they hit it. They spiked it. They had a couple of really nice bounces off it for a good 15 handles, give or take, in the S&P. 567.05. It's all in here. That's the highlights. What I urge you to do is pause the video, read the notes, go back to the chart, and double check the work. Here's an hourly chart, for example. Keep in mind, the morning session, the market didn't do anything. It's up here for 3 hours before it even starts to leak after lunchtime. Again, pause the video, read the notes, go back to the chart, and double check the work. It's all in here, everything that's necessary in order to trade the S&P, SPY, options on the SPY, futures, ES, MES, which is the micros, exchange-traded products. They're all directional trades. Everything you need to trade in those vehicles is in here each and every day. What do we got going in Camp IWM? Down about 7.8% today, $1.72. Against the SPY, it was actually down a little bit less. The SPY was down 0.9%, $5, just like Apple. But the IWM was down just slightly less, so we didn't have any kind of leading indication from my favorite market leading indicator. However, closing below, continuing to stay below the 20-period moving average is not going to be good for the uptrending situation in Camp IWM. But when you look at a weekly chart perspective, they got plenty of room. As long as they're above all the moving averages, trend is your friend. Markets go up, markets go down. So as an umpire calling balls and strikes, we do have a high and we have a lower high. That's fine. And by the same token, we can also have a pullback pattern into the 20-period moving average and another rally upward. That is completely normal garden variety market behavior in the midst of an uptrending situation. We take it one step at a time, one day at a time, one candle at a time. We analyze the market it is, not the one that we want it to be. Bias has no place in this dojo. For now, on the daily chart of the IWM, we will use Thursday's low and that hit of the 50-period moving average to 1508 as our bogey. Below that, you have a breakup candle low, no man's land, gap, and so on, 100-period moving average, and you have other stuff that we'll talk to on an as-needed basis, or we'll certainly do it in the live trading room. What's going on with the folks down at the transportation department? Do you think they know about that trend line? This is from our triangle. You see what happened last week. Look where they closed the week. Who's to say really where they closed it? Is this on to the nuts, to the penny to say this closed above or below? We're just going to call it neutral close. And here they are right there today, right on top of it. So we don't really need to know about it day by day so much. But it is interesting how they do know about that trend line. How do they know? Because the market is the one that draws the trend line, not me, not you, not cousin Jimmy, and not Aunt Jenny. They've got some unfinished business down here now, so today's low is just above a gap. There's a support number under that, but the gap is considered unfinished business. Traders out there interested in the IYT, which is the exchange-traded product that tracks team transports. The number in question is 6590. I did the mathematics. Anything different to report with the Q people? Nope, down $5, just like Apple, just like the spiders. Everything seems to be down $5. They're above all the moving averages, and guess what? You got it. The trend is your friend until it's not. So for now, until proven otherwise, we're going to call this a pullback above all the moving averages in a bullish uptrend. That's what it is until it's not. How do we know it's not? You got to start getting below the low from, for example, Wednesday and last Tuesday. Then you have an unfinished or unfilled gap down here into some other moving averages. That's what would unfold on a downtrending tape again, other than just a one-day wonder like today. Pretty decent down day for XLF, down 1.23%, right back into the 20-period moving average. In terms of being above all the moving averages, hanging by a thread. Look at it any way you want. Look at it from a weekly chart. They're eating time off the clock. Even if they come down a little bit more, they're still just eating time off the clock. It'll look one way on a weekly chart and a different way on a daily chart. 4430 is an important number. 4430 should be at minimum of an intraday bull-bear battle, maybe just even a spike of it. You have a 50-period moving average down there that will creep up each and every day going forward. XLF. What about smash mouth? How about up in a bearish tape? How about relative strength in the semi-space today? Even though it was up 40 cents, it was up. They're above all the moving averages. That bucked the trend, and therefore, what do you do with relative strength? You keep an eye on it, because when the market does rally across the board, and you get a rally in the spiders and the Qs and the IWM and everything else, the SMH will outperform having had relative strength to begin with. That's why you pay attention to relative strength. If I told you how much I appreciate each and every one of you, without you, these videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.